Okay, welcome to Coffee with Cornelius. If you enjoy this show, please hit the like button and subscribe if you want to see more. We are all aware of banks as places where we can deposit funds and get loans. We may also know that banking crises can occur when banks provide a lot of bad loans or when masses of depositors withdraw their funds. Yet, can we also think of banks as politically driven institutions? How does banking differ in a liberal democracy as opposed to a totalitarian dictatorship? Does populism affect banking and financial crises? Charles Calomiris will help us to answer these questions on today's show. He is Henry Kaufman Professor of Financial Institutions at Columbia University Business School and is an expert on banking, corporate finance, and financial and monetary history. His most recent book with Stephen Haber is Fragile by Design, The Political Origins of Banking Crises and Scarce Credit from Princeton University Press. I will put a link in the description below to that book. Charles, thank you for joining us.
It's such a pleasure to be here, Cornelius. Thanks for inviting me.
Thank you. Now, some of my listeners may think of bankers lobbying governments for bailouts or special provisions, but that's about it when we think about banks as political institutions. More broadly, how would you conceive of banks as being political?
Well, I guess a good starting point is to say the following. Chartering banks and thereby defining who gets to be a banker, what they get to do, how they get to do it, and what will happen when things may go wrong with them or I might say perhaps the defining aspect of the modern, that is post-1600 nation state. Banks in a country are a window, and an extremely interesting window through which to understand the entire political system of the country. The political alliances that are formed to try to control power express themselves very much in trying to control bank chartering and bank regulation. Mm-hmm. People often think of bankers as the ones who control the politics of banking. And of course, they play some role, but clearly that's the wrong starting point. The most important thing to recognize about banking is it's the people who want to have access to credit, the would-be borrowers, starting with the state itself. And in the foundations of modern banking, the state chartered banks mainly to provide money to the state. Mm-hmm. So the would-be borrowers who get access to this collection of money are always, whether they're the state, the businesses, the consumers who want to have access to that credit, those are the groups who form powerful coalitions to try to decide what banking systems are going to look like. And in the book, Fragile by Design, Steve Haber and I say, there are some governments that don't have taxes, Kuwait being one. There are some governments that don't have standing armies, Costa Rica. Mm-hmm. There are no governments in the world that don't charter banks. So
that's true. Yeah.
Trying to decide how savings flows in the economy to what uses is a fundamental act of state. So I think that's where you need to start, that those coalitions are being formed, and they're formed differently within each type of political system to determine what banks are going to be. And we call that process of the political jockeying and the formation of those coalitions in the book, we call that the game of bank bargains, mm-hmm. where the outcome of the game is to decide what banks are going to be licensed and regulated to do and to not do, for whom, by whom, and how, if things go wrong, how the losses in that system are going to be allocated, mm-hmm. whether the state is going to assist them or not assist them. So all of those things, which we kind of collectively call the regulation of banks, are very much the subject of political action by coalitions. And those coalitions are not just hypothetical things that some professor has invented. Often that's the case. There are abstractions. We like to talk about coalitions in abstract terms in political science. Nothing abstract about the game of bank bargains. These coalitions are explicit. They're often very much about organizations that are created, about organizations, sometimes political parties with specific platforms. For example, I think a lot of people would today find it surprising to hear that political parties, one of their 2 or 3 major platform items might be something like the question of how much banks are allowed to branch in establishing offices outside of their headquarters. So I think if you started by telling a lot of college students that in the United States in the 19th and early 20th centuries, that one of the dominant questions in political platforms was that one, they would probably be very confused.
Well, a lot of politics does start with the allocation of property rights. In your book, you write about the 3 property rights challenges of banks. What are they?
Yes, thanks for asking that. So participation, if you're going to have a banking system, you'll have to voluntarily want to participate. So participation in banking by its sources of funding, which are people who want to put deposits in the bank or people who want to invest their wealth to be stockholders in the bank, requires that they have to have an expectation that they are going to personally benefit by deciding to put their wealth in the bank, either by buying bank stock or by buying bank deposits, right? You have to have that expectation. So that's a really good starting point to think about what are the property rights that people have to be implicitly thinking about when they make the decision to be sources of funding for a bank. So they must believe that they stand to gain sufficiently by doing so. So the threat to property rights means ex post, after you've put your money in, that you might be expropriated. There are lots of ways to be expropriated. Regulation can be a form of expropriation. Changing the way you put the money in. There are many ways to be expropriated. The bank could be nationalized. Or you might decide to put a moratorium on debt collections. So there are lots of ways to expropriate. So what are the 3? First of all, the people who put their money in, bank stockholders who organize the bank and as stockholders, other minority shareholders and depositors, they all need the first property right, which is the belief that the government's not just going to take over the bank.
Sure, yeah.
A sense of an expectation that the bank itself won't just be stolen by the government or taken by the government. Secondly, the people who are not in control, not the people who are the founders of the bank, the controlling stockholders, the minority shareholders and the depositors in the bank, people who have small interests in the bank, they have to feel like they're protected from a second kind of expropriation, which is the expropriation that the people who are in control of the bank might do. So you need lots of anti-fraud statutes to protect people because banking is a very private business.
Yeah.
You have to have a way, and often what some of my work has shown is that what was the right equilibrium was often to create an objective government-run examination process, really in the interest of the banks themselves, so that you can have both anti-fraud but then also examination. So you need laws to do that. And in the old days, banks used to be big advocates of those laws. There was a really funny thing that happened around 1900 where the comptroller of the currency gave a survey to the US national banks and asked them, what do you think of the examination process? And they said, the examination process is working well, but you need to have people invest more time in the examinations and be more careful. And you should start compensating them, not based on the number of examinations that the examiner does, but the number of hours. So they'll have an incentive to go slower.
Right.
Now, again, that might strike some of your listeners as surprising.
It is, yeah.
But what it reflects is how important the bankers understood that they also needed laws and regulations and credible enforcement actions by government. So government has to, number one, agree not to steal. Number two, has to help resolve some of the problems of insider abuse. And number three, the bank insiders, depositors, and minority shareholders, all the sources of funding, have to feel like they're going to be protected from expropriation by bank borrowers. I mentioned a few minutes ago the possibility of a debt moratorium. So in lots of countries, including the United States, during really bad times, sometimes in some areas, states in the US, this happened a lot in the 1920s, for example, but it also happened in the 1830s. States would impose moratoria on the collection of debt. That's like, well, wait a minute, how can the government say that even though we have a contract,
Yeah.
what's going to be paid, that they come out and say, wait a minute, no, that contract's not enforceable in court. And of course, that can give rise to a lot of legal actions, but it also has a practical effect of, for a time at least, preventing banks or insurance companies, in the case of the 1920s in the US, from collecting on their agricultural mortgage debt. And so if you're setting up a bank, those are the three kinds of parties you're worried about expropriation from. Worried about expropriation from the state itself, expropriation from the insiders who control the bank, and also expropriation through the political process by the borrowers.
Mm-hmm.
All of those happen. So if you're deciding to put your money into it, all three kinds of property rights are going to be very relevant. And now if you don't have those, so in democracies, we really focus on those property rights. But here's the problem. Suppose that you're in an autocracy, and in an autocracy, maybe those institutions don't exist. In fact, I'll even argue they can't exist. And so in autocracies where you have this sort of, important government control through this centralized autocrat, it's not really possible to commit not to expropriate. The one thing that you can't, if you're the dictator, the one thing you can't commit to do is not to abuse your power.
Right.
Then, so how do you solve the problem? What you have to do is, because everyone knows that there's a risk of expropriation, you have to make the banking system really small so that to be a banker and to be a depositor are very profitable. You get a big rate of return that compensates you for that expropriation risk. So one of the things you learn from this, noting these three property rights from the very beginning, is if you start on the democracy side of the equation, you're much more able to create a system that can provide abundant credit. Whereas if you start on the autocracy side of the equation, it's inherent, because of your inability to create protections against violations of property rights, these three key ones, you're going to have to make credit scarce. You're going to have to make a few privileged parties who are part of your autocratic coalition control that credit. They know they can't trust you, but they still know they can trust you a little bit, and the profits are big enough. So, so that's kind of, I think, where it gets really interesting. That right from the beginning, you can see how these property rights help you see a key difference between autocracies and democracies, which is that autocracies tend to be unable to produce abundant supply of credit.
Right, I see. And so could you give us some examples of autocracies today that follow this kind of model that you're talking about? That that have very monopolized banks and very little credit and so on. Yeah.
Well, I want to be very broad, because obviously democracy and autocracy is really a continuum, and we don't want to say that it's so easy. So let me say, I said before, authoritarian governments, autocracies, inherently cannot commit not to steal from banks or others, right? Because they're so powerful. In fact, that's almost the definition of being an authoritarian, is that you can't be limited by institutional constraints on your actions. But when I teach this material, I like to begin by pointing out that no matter how authoritarian a government is, its power is always based on some alliances. There is no such thing as a single dictator who runs a country. Saddam Hussein had an extended family, an extended group of friends. Okay? But let's talk about Mexico. So, and let's also talk about what I mean by friendship. So when I teach this material as part of my development and finance course at Columbia, I start by defining friendship. Friendship within alliances. And here's my definition. If you're a friend of the authoritarian government, that means that the authoritarian will not stab you in the back until he has exhausted all other options. That I see. It does not mean that the government will never stab you in the back, and you know that. So let me give you an example. In Mexico, until the mid-1990s, for more than 5 decades, the PRI had ruled in a long-term alliance with the powerful so-called 6 families of Mexico. So even though there were elections and it was nominally a democracy, It was really, as they called it, it's the Institutional Revolutionary Party is what PRI stands for. So it was basically what I would say is a centralized autocracy based on these kinds of well-defined coalitions. Labor unions were part of the coalition, and it was a very successful, long-lived coalition for a long time. As the government's fiscal needs, the Mexican government's fiscal needs became a problem, so they did create these, a handful of private banks for the six families, and those six families were able to use those banks and their own exclusive access to credit to basically fund their own business operations, which is typical of autocracies. Consumer credit tends to be almost non-existent, or credit for arm's length credit for small businesses almost non-existent. So that was part of the bargain. And then what happened when the Mexican government had fiscal problems, mounting fiscal problems in the 1980s? You may remember that Mexico made major investments into oil exploration and development. And then in 1982, the bottom fell out of the oil market. The Mexican government went from being in a great financial situation in the late 70s to being in a horrible one after 1982. And so they started, as the government's fiscal needs became a problem, the government started expropriating its friends because it didn't have any choice. It did so first by taxing them through something called the reserve tax. And what that is just requiring the banks to start depositing a large proportion of their funding with the central bank at zero interest. In other words, the government said, oh, banks, by the way, we want you to take half of your loanable funds and lend them to us for free, forever, as long as we want them.
That's terrible.
Well, that might sound terrible. Of course, it made credit even more scarce. But importantly, that wasn't enough. And so eventually, at the end of the 1980s, in the middle, I guess, of the 1980s, they had to expropriate the banks. So these were their friends. These are their closest friends. So allies with authoritarians know that they will do this when they have to. They know that they're not protected by legal institutions, but they participate in this alliance in the first place because they get some monopoly rents while the getting is good from being willing to bear the expropriation risk if things go south. And this is why authoritarian systems inherently must be systems where credit's very scarce, and also where we tend to see distortions, the credit's not being allocated at arm's length, often with this sort of label crony capitalist. Because the people who are part of the alliance aren't just getting monopoly profits from the scarce credit, they're getting monopoly access to fund their own industrial groups through their special control of these banks. But that's all part of the political bargain. And this is quite common in authoritarian governments. This is the way it works.
That's crazy. Now, of course, democracy has its own problems, especially when it can fall prey to populism, which means, I suppose, the undisciplined rule of the majority over the minority at the expense maybe of minority rights. What problems does populism pose for banking?
Well, again, coming back to the same property rights. So I would define, just as you said, the most extreme populism as a majoritarian democracy without any constraints on the momentary actions of the majority. So for example, a perfectly populous state wouldn't have a Bill of Rights. It wouldn't have property rights protected credibly by institutions. The absence of those kinds of constraints means that people could vote to expropriate, either by taking banks from their stockholders or by taking away the rights of banks to collect on their loans with debt moratoria, that they could vote at any time to just take whatever they want from anyone, including banks. And that is how extreme populism can threaten the existence of a healthy banking system. Because if you're in that kind of populist system, the people know that their property is not safe. And we have a lot of history of this, which I'd be happy to talk more about in the US, where, again, there's a continuum here. I don't want to make it sound like the US is the extreme case of populism. It isn't. But it's much farther down that continuum than, for example, Canada is, in terms of the way the Constitution was designed and how things effectively played out in terms of limiting certain populist actions in banking. So we spend a lot of time kind of making those kinds of head-to-head comparisons, because you can see Canadian and American history were linked throughout. And there were a lot of interesting things happening at the same time in the two countries. There was for example, there was a Canadian prairie, just as there was a US prairie, and they had all kinds of political preferences, the people who lived there, and they pushed for similar things. And they won a lot in the US, and they lost always in Canada. And so watching the political struggle of particular interest groups, and how in the US, because of the way the Constitution was established, how certain populist groups were able to gain control over certain aspects of policy, while in Canada they were prevented from it by a process that political scientists sometimes call veto gates, that is creating barriers to special interests being able to hijack things that are supposed to be for the general public, like access to credit at arm's length in the banking system. So the Canadian Constitution was very much designed to create those kinds of protections. The US, now many Americans who are listening to me are going to say, well, you must be an idiot, Professor. Haven't you heard of federalism? Haven't you heard of Senate and the separation between the legislative and executive branch? And of course, we spend a lot of time talking about that. And all of those things were part of very much trying to constrain populism. However, that doesn't mean that they were entirely effective. And it's important to remember that history matters. The US was a country forged in a populist uprising. Canada was a country forged largely by people who had rejected that populist uprising and moved from the US to Canada. Because loyalists, right? And so there's more to the story than that. There's a lot more to the story of how the countries evolved so differently. But that's a very important part of understanding how two somewhat similar countries in many ways ended up with such different banking histories because of this constraint, as you asked, what could go wrong? Well, debt moratoria could happen. They happened in the US, they didn't happen so much in Canada. I'll talk, if you like, about deposit insurance. It's a complicated topic, but the way it was politicized, the charters of banks, and I mentioned before, branching, allowing banks to operate in different areas. So there were different political groups that had very strongly different views on these issues, because once you understand how those policies work, you understand that they cost some people a lot, they benefit a few, and they're generally very hot political potatoes that are being fought over. And so in the US, I think it's the US turns out to be, and also Great Britain, very interesting examples during different points in their history of how populism affected the banking system, the allocation of credit, and where actually Canada is a wonderful counterexample to much of that.
Now, someone naively looking at the United States versus Canada would say, but wait, United States seems to have a more dynamic, innovative banking system than Canada. Isn't that a red mark against Canada?
And I would say that is a very contestable proposition, that the US has a more dynamic and innovative system. So, and we talk about this a little bit, Stephen Haber and I, in the chapter on Canada. If you look at the Canadian banking system, one of the things that you'll find is that most of the things that were innovations in terms of universal banking, different kinds of banking services, actually happened around the same time, or in many cases earlier in Canada. And they happened in the context of the existing Canadian bank charter. So one of the things that's interesting is Canada doesn't have a shadow banking system. No. The US is dominated by shadow banking systems. So the regulatory battles in the US where special interests are doing things is very different. It tends to give rise to shadow banks, ways to get around that regulation. In Canada, current law, but this goes back to the 1860s, every 5 years now in Canada, all the banks have to be rechartered. All the bank charters are completely redone by law every 5 years, which means that the chartering process is always changing, is always a. So actually my own view is that Canada is a more responsive chartering system by construction than the US. The innovations that you're seeing in the US are often part of a shadow banking system to try to accomplish things maybe in an innovative way, because the US goes for long periods of time without changing aspects of its law, even if those aspects are very debilitating. So, we had a major banking act a couple of them in the 1930s. The next time we had, I would say, a major one wasn't until, there was a Bank Holding Company Act in the 50s, but not really till the 1980s did we. And then 1991, and then 1999 and 1994, there were some important ones. But pretty much we haven't really changed the rules except those 4 or 5 different moments. And very long lags, so that a lot of things that were put in place in the Depression didn't change till the 1980s or the 1990s, many of them. So that in Canada, that's not possible, because in the US, while the politicians have to decide they want to change the charter, in Canada, every 5 years, they actually have to reconsider what is banking and how's the best way to charter. And so it's been, I would say, a much more kind of responsive chartering system, which is part of the reason you don't see any shadow banks.
I see. Well, in a liberal democracy like Canada, it seems like things work very well. And in fact, you've written that a liberal democracy is perhaps the best political system to encourage well-functioning financial institutions. Are you worried, though, that in a liberal democracy, liberal elites can politically capture the banks?
Mm-hmm. Well, it can happen in the following sense. So I want to emphasize, and I know you're aware of this, but just for the sake of the listeners, the word liberal, the way you and I are using it right now, means classical liberal, which means that it's protecting the rights of individuals, like those 3 property rights we started talking about, right? Against special interests. That's kind of the key, almost the definition of liberal. It's at the opposite end of the spectrum from the populist. So it has all these veto gates, all these limits on control that are there to prevent majoritarian tyranny from undermining the rights of individuals. It's not liberal in the sense of our current usage in many countries, meaning leftist. So that it would almost be, in that sense, an oxymoron to talk about special interests in a liberal democracy gaining control, because almost by definition, the point of the liberal democracy is it creates veto gates that prevent that. However, I do want to point out that before Canada was truly a liberal democracy, when Canada was just getting started, before it was a country in the 1860s in the formal sense, when it was just, let's say, Upper Canada and Lower Canada, and before it had really developed as a full democracy, the incentives were very strong because the British government wanted to encourage immigration. And unless you have democracy, you don't encourage immigration. And so they saw the need to create constitutional change in Canada, which of course happens first in the 1840s. The British Privy Council sends people over. And what they learn is that the pre-existing sort of liberal democracy wasn't really enough of a liberal democracy, and that the banks were being chartered based on these cliques that were operating in Montreal and in Toronto, which at that point I think was called York still. And that those cliques were actually creating privileges and rents for particular groups. And so the founding of Canadian banking, of course, was very much a privileged elite within what you might call a liberal economy as part of the. So if that's what you're referring to, yes, but what that really tells us is Canada had not at that stage really become a liberal democracy.
I see. That makes sense. So many economists would argue that in a well-functioning banking system, you need a central bank. What should the function of the central bank be?
So I think that of course, this is a real interesting topic. I've devoted my career to trying to understand this. So let's start with what I think people can agree on, that central banks mainly are tools to deal with the threat of financial crises by helping to avoid or address, if it happens and they can't avoid it, systemic risks, things that threaten the entire banking system. We're experiencing it right now with the COVID virus. The whole banking system is experiencing big losses. Maybe the banking system will collapse, or we won't be able to get enough loans paid back so that we can fund ourselves And if that's the case, then what happens? So I think it's pretty clear that establishing central banks, and I think that if people are wondering, what does central mean? By the way, when the Federal Reserve was established, it was established as 12 different banks, 12 different regional banks. The founder of the Federal Reserve would roll over in his grave right now, Carter Glass, one of the founders, if he heard someone refer to what he did as creating a central bank. So I want to be clear. I think the better way to think of it is as a banker's bank.
Okay.
As a bank that's being established, whether it's centralized or decentralized, as the Fed was, but in almost every other case, in fact, in every other case, it's centralized. But that shows you something about how politics mattered in the US, that created as 12 different, not a central bank. So central banks are there to be bankers' banks, to deal with systemic risk. And I also want to point out that the word central bank is a fairly recent development. So for example, in Canada, not only was the word not used, but prior to 1935, there was no central bank. There was no government. So the Bank of Canada was founded in 1935. Canada's banking system performed exceptionally well, even in dealing with systemic threats prior to 1935. Remember, Canadian banking had existed for over 110 years prior to 1935. And it's a really interesting question. Well, so central banks are there to deal with systemic risks. What did they do in Canada? And the answer is the Bank of Montreal, which is the first chartered Canadian bank, chartered in the 18 teens, was a coordinator with the rest of the Canadian banks to deal with threats so that they work together. And I don't want to take too much time to explain it. Your listeners can read all about it.
Yeah.
But they coordinated their action to deal with systemic threats. So in the place of a central bank, they did exceptionally well by simply being able to, because there were a few number of them, and they all operated throughout the whole country, that they could easily coordinate their actions for the entire country, even with only a dozen people meeting in a room, or maybe at some point 20 people meeting in a room, because they were all operating nationwide franchises. There was a small number, 20 people meeting in a room can reach agreement to help each other to deal with skills. 100 people can't. That's a really important thing to think about. And how many banks were there in the US at that time? Let's say around 1900. Well, there were about 20,000. And they were all geographically completely isolated from each other. So that you had spread out over the whole continent. So the US was very different from Canada. Branching also meant that Canada could, without a central bank, actually accomplish a lot to deal with systemic risks. So, but anyway, to perform their jobs best, central banks, especially in democracies, they're focusing on systemic risk. But I would say they need to have very clear mandates about what they're supposed to do, very clear powers about what they can do, and clear limits on those powers when dealing with systemic threats. And since, talking about Canada a little bit, Canada's system today, I would say, is really a model of all three. So the Bank of Canada's mission is clear to deal with systemic risk. Its powers to do that are clearly specified, and the limitations, so the circumstances under which its powers may be inadequate, and where it then has a mandate to appeal to the central government for the government to play a role.
I see.
Because if you're going to have a real fiscal cost, if it's not just dealing with a liquidity problem with normal tools, if it's going to be really something fiscal, well, that shouldn't be the job of a central banker.
Sure.
That should be the job of the citizens through their government. And so what's nice is the current regulations of the central banking in Canada give you this kind of three different aspects. There are things the central bank can do without asking for permission. There are things the central bank can do, but it has to notify the government. And there are things the central bank can't do, and it must rely on the government to do. And by spelling out those things and how to deal with those systemic problems, I would say Canada is really a model of how you should think about dealing with systemic risks within a liberal democracy.
Right. Well, that answers my question actually about democratic oversight of central banks. But I do get this question quite a bit by students and friends, especially those of a more libertarian persuasion. Should we return to an asset-backed currency such as the gold standard or the silver standard or something of that nature?
Right. Okay, so let me start off by recognizing the merits of it and what it did manage to achieve historically, and then explain why I think that there are better ways to achieve it and why in today's world politically it's really not even feasible. So first of all, asset-based currency like gold standard currency, if designed properly, can work reasonably well at some things, especially at ensuring long-term price stability of the money relative to the value of that asset. So if you want to know, can you create, by creating this parity with laws, can you at least hypothetically create a stable exchange rate of your currency relative to gold? And the answer is yes, you can. And that's really the main thing people want to do. Okay, but what's the problem? Well, first, what if the asset itself is not stable in value relative to the bundle of goods and services that we consume? Then you could have very unstable and high inflation, even though you're able to preserve the value of the currency. Now, that's not just hypothetical. During the post-World War I return to the gold standard, the value of gold the arrangements among countries under this gold exchange standard was not very smart. And the value of gold was not stable relative to goods and services. France and the United States in particular experienced big inflows of gold. And under the old understanding of what would have to happen to create the stability of the value of gold relative to goods and services all around the world, they should have expanded their money supply dramatically.
Yeah.
But France and the US both absorbed the gold without increasing the money supply. And so what happened was there was a global deflation. And so by staying with the gold standard in that circumstance, we caused the Great Depression to be much more severe than it otherwise would have been. And so you could say, well, can't we fix that by a policy where nations are obligated to perform according to what sometimes people call the rules of the game? Conceivable, it may be, but it's very hard to think about how you enforce rules for nation states. And so my own view is we no longer live in a world where that's very feasible, and we certainly can't rely on it. Secondly, adherence to the gold standard requires governments to do something that they're very unlikely to want to do in today's world, which is to eschew some fairly aggressive countercyclical monetary policy actions, which means they'd have to be willing to tolerate more severe recessions in the name of preserving the gold value of their currency. In 20th century democracies, that's probably not feasible. And I would even say it's not really desirable. So my own view is long-term price stability, consistent with something like, and I'll use a term of art, a Taylor rule or some other kind of monetary policy rule, which is part of what's typically called a flexible inflation targeting regime, that we can achieve long-term price stability with lots of countercyclical activism by the central banks. But to do that, we're going to have to let the exchange rate move a lot over time. We're going to have to let the relative value of the US dollar relative to the euro or the value of the dollar relative to gold, we're going to have to let that vary. So my own view is I don't think that we have an international basis for belief that we can achieve stability of gold in terms of other things. We have a lot of not just hypothetical reasons to believe that doesn't happen. So the long-term objective is not even necessarily going to happen. On a short-run basis, it requires giving up on countercyclical monetary policy, which I think is not politically feasible and probably not a good idea. And so I'm not saying that there's no potential gain to this. I'm a fan of the gold standard as a historian. It was a useful institution. I could talk about how Russia and Mexico made great use of the gold standard, especially during authoritarian regimes like the Tsarist Russia or Porfirian Mexico, to anchor their currencies and make commitments that their own citizens and international creditors could believe in. So I'm not saying it was a useless thing. I'm just saying I don't think it's really either feasible or particularly desirable right now.
That's fair enough. Now let's turn to the 2008 financial crisis, which had its origin in a subprime mortgage crisis. In response to this, the Bush government implemented the Troubled Asset Relief Program, commonly known as TARP, which was essentially a bank bailout. A number of studies now show that not only were politically connected banks more likely to receive TARP funds, but politically connected banks were also more likely to benefit from them. Given this apparent political favoritism, shouldn't the government have just directly bailed out homeowners instead of bankers?
Mhm. Yes, it's often talked about. First, let me just start by agreeing with the factual premises that you're starting with.
Hmm.
So yes, there is pretty hard to contravene empirical evidence that small banks, and I want to emphasize, really TARP was two different things. So the largest half a dozen banks that were in trouble in the US, let's say the largest 8 or 9, were the first recipients of TARP through what were not even voluntary. They were required to accept government investments in preferred stock in their banks. A couple of them did not want to participate. They were actually pressured to, which is a longer story, not worth getting into. But then, to try to deal with the smaller banks, TARP was created as a program that you could apply to gain the same kind of relief. And there, it is true that when you control for other attributes of banks, you find that measures of political influence seem to be dictating access to credit and benefits. So yes, I agree with you that that was a negative. However, I don't think that it's correct to say that we could have achieved all the same things by just giving assistance directly to homeowners. By the way, I did advocate, and as an advisor to the John McCain presidential campaign in 2008, I specifically advised them to come up with a plan that would provide direct relief, much more ambitious than what was ever done for mortgage homeowners, those who had borrowed with mortgages. So I agree that it would have been a good idea, and it would have had very good systemic consequences. But here's the thing, it's not really the same. You needed TARP too, because if you have a systemic shock, like right now with COVID, affecting the banks, and suppose they're all now going to be insolvent as a result of the shock. And so you say, well, I guess we don't really need the banks. Let's just forget the banks and just worry about the consumers. Then the question is, okay, so tomorrow, after all the banks are gone, how are we going to organize our payment system and our supply of credit for people who have bona fide projects that need funding, or the consumers who want to borrow to buy a dishwasher or a car or a house? How do we structure that if the repository of information about individuals that allows us to screen people, to know what we're doing, if that professional competency to run a bank is all gone? And then you can say, oh, well, they could just reorganize themselves. I think what we've learned from a lot of empirical studies is, while that's true conceptually that somehow new banks would come into existence, the amount of delay and disruption and chaos that would result and the scarcity of credit supply for several years at least that would happen during that would simply not be worth it. So what we really need to do, and I've been a big critic of TARP, not just because of its political problems, but because of the mechanisms that they chose. It was a very, very poorly designed mechanism, in my opinion. The TARP could have been designed based on the experience we have with similar kinds of programs around the world. It should have been designed much better. And it was actually, in my view, a failing the way it was designed. That's a much longer story. But I just want to say something like government policies of assistance, starting with collateralized lending, which is the least risky thing that a central bank does, going all the way to credit guarantees, preferred stock purchases, and common stock purchases, which were used for a couple of the banks. So a couple of the banks in the US were not really able to stand on their own even after receiving the preferred stock purchases, and then they were given common stock, government purchases of common stock. So do I think that that was a good idea? The specific form of it I would have designed differently so that we would have had less taxpayer risk-taking, we would have had less political corruption. I think it was possible to do better, but I do want to defend the idea that if you're sitting in a situation like right now we are with COVID, where we can imagine if loan losses really mount, that banks could be insolvent, I think that we as a society would not really gain from just watching our banks all go down like the Titanic, and then being able to confidently opine that, well, let them eat cake. Eventually people will get credit, right? I mean, I just
Right.
don't, that's not a realistic thing to say. It might make somebody feel good to say that, but I don't think that if they were actually the ones making the decisions, and if they were saying that that's what they would decide to do.
Yeah, it probably wouldn't be very feasible. Now, you've had a pretty great career researching the things that you do. So I'd like to ask you, what advice would you provide to those considering economics as a career? Maybe undergraduate students, for example, who are thinking about that.
So, I have something, I give long speeches. I've had about 52 PhD advisees over the years, and I also mentor junior faculty quite a bit. I love mentoring.
Wow.
About their careers. I really enjoy doing it. This is your hardest question so far, because part of the first thing I tell people is not to listen to me and not to listen to their advisors too much, but to make sure, first of all, if they're studying economics, that whatever questions get them interested. There's a sad thing that happens where a lot of people get interested in economics and they can tell you why they're interested. And those reasons are things they could discuss with their grandparents, for example.
Mm-hmm.
And then they become economists, and all of a sudden, if their grandparents ever asked them, well, what are you working on? They couldn't even explain.
Yeah, that's true.
What that's telling you is that what happens is somehow important questions are the things that get people interested in being economists, but then somehow they don't seem to work on those anymore.
Mm-hmm.
So what's happening is economics is suffering a major problem in the quest for technical rigor, which I applaud and I hope I exemplify in my research. We're spending so much time training students in statistics and math that we're failing to educate our next generation of economists to know much about things that matter, or about being willing to ask interesting questions about economics. The tools have become a little too important. You might say the tail's wagging the dog a bit. And this new emphasis on tools also is part of this sort of new emphasis on bulletproof, what's called causal identification. This means that our journals are now rewarding clean identification of the direction of causality more than the importance of the question that we're addressing. And of course, the more important the question, inherently, the harder it is to identify the causality. And so the whole profession is moving toward this kind of technical bias toward causality, bulletproof causality, and rather than the importance of the questions per se. So I would say economists today know a lot about statistics, a lot about math, a lot about how to demonstrate causality with various cute little tricks. And then they want to apply those to questions that will give them clean answers to that. So economists today know a lot about statistics, math, how to demonstrate causality, but they know very little about the most important facts related to our economy or about how politics and history interact. So how does that all translate into advice? I'm very worried that if I were a young person today, I probably wouldn't go to get a PhD in economics myself or a PhD in finance, even though I've spent my whole career as a professor of economics and finance.
Okay.
It's a sad but honest answer. I would consider going to political science departments. I would, or within economics departments, finding out about economic historians who are much more generalist in their approach, much more broad in what kinds of disciplinary connections they try to make. So, and I'm an economic historian by training, so even though I sort of migrated more into the finance field, I still do economic history quite a bit. So I think my own view is we're kind of at risk right now of this current generation of economists who are running economics departments or finance departments are ignoramuses. And so if I were a young person, I can't imagine having to go to an economics or a finance department and have those people to help define for me what interesting questions are that would define my career. So you have to look very carefully to find your advisor, I would say, in today's world, and be open to places like Stanford, NYU, and others, which have really interesting political scientists who are well-trained economists. Let's not get into too much the labeling. Stephen Haber, my co-author of Fragile by Design, is, I think, doing the most interesting work in social science right now. And he's a very well-trained economist, as well as a historian, as well as a political scientist. If I were a young person, I'd want to have him for my PhD advisor. And that would mean going to a political science department. Study economics, but so look for your advisor, look for, and make the commitment to yourself that through your career, you're never going to get to the point where you can't explain to your parents and grandparents why you deserve to be fed that day.
Mm-hmm. That's actually very surprising advice, because most of the advice you get now is take a lot of math classes in your undergrad, take a lot of statistics classes.
Which is all true.
Yeah.
Nothing advice is, you can't get away from it. But my point is, don't be absorbed by that. You still have to play that game. You have to have those competencies, but don't let them drag you into the trivial questions. Don't let them drag you into the careerist nonsense that economics has become. And I say that as an indictment. Economics is not an interesting field anymore. That's sad.
Yeah, I mean, much of what you said I would agree with, actually. It's very sad that we prioritize focus over causal identification over the really important questions. Now, we're getting towards the end of the interview, but I'd like to ask you, Charles, where can we find you online? Are you on Twitter? Are you on YouTube? Where are you that we can keep in touch with your work?
So I'm a grumpy old man, Cornelius. Sometimes I give speeches or interviews like this, and it's a pleasure to do it, and they're often available on YouTube. Mainly, I write things that try to think through carefully difficult issues based on facts and evidence. People can read them or not. It's going to take some time. Or even better, they could enroll in my classes. That's how I choose to communicate. And I leave the blogging to people who think that their superficial and brief communications accomplishes something useful. It's not for me. I think it takes away from meaningful investments in people's learning because it absorbs too much time, this banality. Here's my advice to your listeners, if they doubt what I'm saying. Take 1 week off from reading the crap that is produced by news organizations or bloggers and read Fragile by Design. I know it's a self-serving advice. Read Fragile by Design. Take 1 week off from reading all the other crap. Don't read one news story the whole week. Don't read one blog the whole week. Just read that book and then consider whether you want to keep participating as much as you are in social media and as little as you are in reading books. Because what I find, young people aren't reading books today.
No, and they aren't. They really aren't.
It's very disturbing. So as I told you, I'm a grumpy old guy. I don't think social media has made learning better. I think people are more ignoramuses now than they have been for many decades.
I would agree with that. And I will put the link to Fragile with Design, where the viewers can buy it, on the description box below. Charles, it's been a great pleasure to have you on the show. Thank you so much for joining us.
Thank you, Cornelius. We hadn't met before, and it's a real pleasure for me. And I hope we'll be in touch and find out more about what you're up to, too.
Absolutely. It's a real pleasure for me, too. Thank you.